welcome to my video of where I'm going to break down kind of what's going on in the stock market, why it's behaving the way that it is, and stuff like that. And this is due to kind of a popular request as of something I posted here where I was talking about the trade deal, stable markets, etc. So I'm going to break that down in the video form, and hopefully that'll make a little bit of sense. Additionally, though, I'd like to start this off by saying thank you to all 23 subscribers that are here. I know it doesn't really seem like a lot, but I think this is cool because just earlier this week I was at maybe what, like 12 or something like that. So that's almost 100% increase. So, that's pretty awesome. I mean, starting from zero this is what progress is. And I think, options and stock kind of works the same way. If you play it smart, if you keep going, uh, you will in the long run, I think be successful as long as you kind of play to that. I have opinions here and there about whether or not we're gonna play long-term investments and stuff like that. How that goes, maybe I'll talk about it in a separate video, but probably not this one. But let's get right into this. Let me break down what's going on. So in this comment, I had said, all right, I definitely agree with the information being reflected. This is in regards to the video. The trading fraternity was talking about how you can kind of see what's going on with the U.S. dollar in relation to the Japanese yen, and how our power against them has been increasing and decreasing accordingly with respect to how our markets are being perceived. Now, as that goes on, more in foreign investments start coming into the United States when international markets are seen to be significantly less stable, which right now, especially with the coronavirus, it's very big. And then then we have the trade deal, which there was talk on the first drop that we had on this day. There was a talk about saying that it's possible that China might back out of the deal with everything going on in the coronavirus. So that was obviously frightening to a lot of investors and stuff like that. And so that had that first effect, and the second effect had a result. So uh, so so we'll go back a little bit further and we'll talk about how this market's been moving. So since January, which is right here, we've still had more or less a rough increase that kept going. We had a pullback around this time, and this was like half the stuff was like the coronavirus, most of it was, and then the rest of it was the climbing of the market. And what's important to note is that we kind of have disregarded a lot of market data up until now, because for the longest time we've been receiving PMIs and the CPIs and all these different indexes or indices that described how we were doing, and most of them a lot of the time had pointed to a contracting economy, and that matters because your market economy should be reflective of the global GDP. And as the global GDP starts to kind of stagnate, you should also see that markets start to stagnate. And why do global GDPs start to stagnate? I mean, we've had 11 years of unprecedented growth for a while now, and now we're here in this time, and we're at all-time highs. And so how this kind of reflects our market is that we're seeing the effects of a strong GDP growth in a market where that's not necessarily true, and we're noticing that, and it makes sense. This is how these contractions tend to work. I mean, when you're having this growth, then you start to seeing that certain things are overvalued. For example, the stocks are, I genuinely think at some level they're hiked up quite a bit, actually. And so these little things eventually they start hitting a lot harder depending on the time. And right now I think we're in that time. So one of the bigger reasons that I think we've been holding up for so long is because regardless of all of this, the US has been seen as a stable market economy. And as a result of that, foreign investors, outside investors have been putting their money more so than usual, I think, into the U.S. investments. And you can see that by kind of these unprecedented amounts of volume. You have to kind of go back and do your research. I'll actually try to compile all of the data sources that I'm using, and I'll post those, I think, in the in the description at some point. But as far as that's concerned, we're getting growth from these outside investors that are kind of holding this market up. But that's not going to hold forever, because once it becomes realized that the U.S. market is not as stable anymore, then that's going to be a problem. Now, what we want to think about now is these two drops right here. What happened in that time was that the stock market had kind of taken that bad news pretty strongly, and with that really bad news, we saw really high volume. We're up 179% higher volume than normal. So you can do the math. That's part of your job too. Um, for how much more volume this is, right? So the average volume is typically about 63 million, or is it billion? I actually can't see the whole thing, but I think it's probably billion. But um, I just use this. This is my indicator for it, and this next one is almost double that. So that's what is kind of going on here. That this itself is not the black swan. It's not the thing where everyone is going to be fearful, but this is the potential precursor. We could very well just see it, hold and then melt back up, and then that could continue on for another however long. However, if it doesn't do that, if it starts picking up, if the bad news starts hitting in tandem over and over again, we might actually see some serious drops. And typically in some sort of bearish economy, that we'll start to see that stock markets will drop about 40% roughly on a huge one. So now this is something I want to cover. So I covered this the SPY drop. I really quickly I posted it twice. And then there's another part, which is that the Fed has injected $500 billion. Now this is a very big deal, and the reason that is because we're doing this to keep interest rates low, right? But typically, to get us out of a bearish economy, a recessionary economy, we need to drop interest rates typically about 4 to 5%. But if you pay attention to the Fed rate right now, you could tell that we're not on that. We're at 1.5 to 1.75. So the Fed is literally out of ammo. And you have to understand that the Fed does not give a shit about the stock market. The stock market has very little influence on how they make their decision. Yeah, the S&P 500 does indicate a lot of stuff. So you'll see those parallels, but they don't care about that. They care about monetary policy, right? So right here we have monetary ammo to get us out of that recession. What we've been doing up until this point is quantitative easing. So slowly trying to pull it back, hoping that we can rise this economy. And what our trend has been is that we're pushing for zero before the recessionary contraction actually begins. And that is where a lot of this problem is. I mean, the Fed needs to find a different way to handle itself. So there's this thing I read and I really liked it. History never repeats itself, but it rhymes. And this is true because the market is not going to do what it did in 2008. It's going to do something else in a completely different way for a completely different reason. This is not 2008 for the record. But it is going to do something similar. It is going to do something that looks like it mirrors it, but they're not the same thing. And this is very accurate as far as how our economy is looking. So we've been seeing the rate hikes for a little bit back in 2018, but then we also saw that the Fed has 3 times consecutively cut the rates starting in I think June, and so after that we had dropped the interest rates quite a bit to where we started realizing that they're kind of out of ammo. They're out of tools to keep them that way. So as far as the investing, the Fed rate monitor tool, you can kind of see that we're not expecting a rate hike or a cut as of this moment. If the futures start to price it in, that could change in time. But we will have to see how the rest of this information as far as the economic calendars go. So, for example, this coming week, we're going to start seeing a lot more information. The National Activity Index doesn't have that much of an effect, but the housing price index, consumer confidence, these things kind of matter, right? And so, we've been expecting to see that the natural gas and oil is going to be reflecting this in the trade prices, but that's not what's doing it. Right now, with the hike up of gold, that's been really kind of shooting up like this, that is where we're seeing a lot of the action kind of take place, the market changing. You even in this sense, Bitcoin had this injection go in. I don't remember the exact quantity, but there was a massive injection that shoved Bitcoin's price up like a ton. And so now Bitcoin is worth, it's at almost 10,000 again when it was at 8 earlier this month, or earlier this year probably. And so we saw these hikes, and now we're seeing it happen again in the gold ETFs. The TLTs are starting to react with it as well, really strongly. It's almost about some of our TLTs are going to hit. The golds, I timed a bit earlier, and I timed a bit maybe too early. I wrote it onto this one, so earlier that month, but it was actually a secondary week after, which is definitely something I should have waited on, despite the fact that I was still up on those, but this first bump is where you kind of saw the market started ingesting that, and then you started seeing the return of the reversal. Okay, we're recovering from all this. The market forgot about the coronavirus at some level for a long time, and so we're seeing this rise, and we're seeing kind of oil not have the same effect as strongly. But as far as these indicators go, right here, we're seeing these different notes, these different reports that are either supporting an expanding economy or supporting a contracting economy. So those two different things are kind of like the bears and bulls in this sense, and we're starting to see that the bears are winning in this round. Our indexes are not as good as they once were, and additionally, despite the fact that our jobless reports and stuff like that are coming out a little bit better, we are having more jobs. We are not producing more because GDP is completely dependent on the production of not just sales but of items of product, right? What is your gross production, right? Because we sell however much we make however much we think we're going to sell. That's typically how that goes. We've been, and one thing we've been seeing actually is we are overproducing and we're getting a surplus, and you're going to start seeing that a little bit more. I think the first place to look at where I think these drops might go is Apple. I think Apple is an amazing stock to notice the pre indicators of how I think we're going to go as far as this economy is headed. Like I said, so now let me get ahead to my predictions. I think that it's possible that these 2 days, despite the fact that they're not a big deal, they're probably going to make headlines. CNBC is probably going to freak out about it, and they're probably going to say, "Oh, this is it. The economy's done for." That's not true. That's going to induce fear, and you want to play the fear, right? You want to get people's money out of that fear. That's your job, and you can, and you should. But I wouldn't swing it, like I wouldn't overswing anything right now because the volatility is too high. And you can tell that by looking at the VIX, right? The VIX is going kind of all over the place as of this moment. But one thing that I actually do want to show you that I think is probably one of the most important things is the ADD. And the ADD indicates the health of the market in general. And as of this moment, the market health is not that good. And I've been noticing it start to kind of slide off on the ADD. The ADD is a little bit hard to read. I'll make a video about how to read it exactly a little bit later. But for now, just understand that the market health is not phenomenal at all, and it's not justifiable on these on these huge jumps right now, right? And so, like I said earlier, we're running out of ammo as far as how we're gonna defend against the recessionary. So because if we hit a recession and the interest rates are already at zero, what are we going to do then? Where's the quantitative easing going to come from? We don't have anything else to give them. So there's nothing else to give, and now nothing makes any more sense. And additionally, because we're printing so much money, we're trying to hold up those rates. Eventually that might come back to bite us. So I think the Fed actually, I cannot say that they're playing this well. I'm not going to say that they're playing it badly yet because I don't know, but to my eyes as of this moment, and I don't know what their plan is because I'm not the Fed, but to my eyes at this moment, I don't know whether or not we're in a good place as far as fixing something that would be a cataclysmic drop. So keeping that in mind is pretty important. As for the Japanese yen and the Chinese yuan, you want to see that the Chinese yuan is back above 7 right now. So we saw that hike up go. We fell below. We've kind of been mostly stable. The coronavirus has had weird effects, but it hasn't been terrible. And then what I do want to look at though is the Japanese yen is as you in the video that this is in reference to, we've kind of seen how the market has started to react to the Japanese yen over the last few months. This huge hike, for example, the stability, whether or not the U.S. dollar is stable against the rest of the world. That's how you can kind of tell whether or not the U.S. market is perceived to be stable. That's why I read it way back when I did. And I bought those gold calls because I thought that, the market is starting to seem to be more stable, but we don't know where they want to put their money, and the money just so happened to be gold, right? The stable indicator, so to speak. So just keeping that in mind as you go about all this. There are these varying factors. Now, I want to cover, this is my last thing I want to cover, the gold, the U.S. Treasuries. Now, we don't have technically an inversion the way that you think. The way that I tend to define it is the 2-year, 10-year inversed, right? Which means that the 2-year is above the 10-year, which is not the case as of this moment. But what is the case is that the 3 months is higher than the 2, 5, and 10-year. The only thing that's above is the 30-year. The 30-year was of interest several back in August of 2019, and the reason that was the case is because the 30-year Treasury had hit the lowest it had ever been, right? And so that was very strongly a cause for concern. And what this means is the 3 month is yielding a higher percentage than the 2-year, the 5-year, and the 10-year, all of them. That is really, really not a great thing. And the reason that's not a good thing is because what this means is this means that the economy, or that the people participating in the economy, in the markets, are thinking in the most short term possible, which is the 3 months. And not only is it different, it's a bit drastically different. There's no slight spread or slippage here. These are fairly big differences in the interest rates, and so in these treasury rates. So I think this might be kind of a very pivotal point for it. It's where we're seeing how short term this market is acting, uh, that we might actually start seeing the downward run. So if this doesn't adjust itself in the next 2-3 weeks, then that I think could actually have some sort of very bad effect on how the market starts reacting, and then you're going to start seeing these like hike up really quickly. As far as all of this is concerned, but I mean, as far as what my opinion of is where we're going, I think that we could keep going. I definitely think we will keep going. If it's not right now, it will be soon. And in that case, I'm loading up on SPY puts. I mean, but I do want to, I think, properly hedge my position. I think these debits are starting to look really amazing as far as these like positions go. So, and these debits are really good because you can get them at the end of day. So it's something I did on Friday. I'll show you. So on Friday, so this is me being in Tesla. Um, so what I did with this account, I'll show you the longer term on this. So the what I did with this account kind of fell below 130. It doesn't represent it here, but then we entered in some Tesla calls, a debit spread on it, and it took off really well. I wanted it to expire in the money, but it probably wasn't gonna. So I closed it, and then I flipped the side into a credit spread, and so that adjusted it even more. So now the account is, it's doing pretty well. This account is probably one of the more popular, like favorable ones. The most favorable one is this one. So I was in a Google debits or credit spread above 180, and what I noticed is as the market started to show that decline, I flipped my position by getting a debit spread on it. And so I got a debit spread at a higher place. So I basically maxed out on that debit spread, right? And so, this account is one of the most successful accounts that I've ever, or no, it's a very good account. I mean, this account started at like 140, and so we pushed it up to about 1200. So that's pretty good. And we did that through the use of spreads, calls, just outright like predictions, I think sometimes, which is not exactly smart all the time. But it was a solid trend, and we saw it. And so I think buying debit spreads is the season now. So that is how I would probably start playing a lot of these, because I can collect on an entire maximum, right? It would be a lot less risk and a lot more gain. So I like that a lot, actually. So yeah, but that's what I think as far as the markets are going. I think we're probably gonna go lower, and I don't know how much lower. We're gonna seek our levels. 320 is probably where we're headed back if we are headed down again. It's a very strong, powerful level where we get a lot of volume kicked back in. So but yeah, I think it's time to change your opinion because the markets are changing, and so that's one of the most important things to keep in mind. Thank you guys for watching. If you liked the video, subscribe. We have a live stream that comes on in the morning as well. So we cover different things. We're trying to grow as well. So yeah, but thank you guys for listening. I'll see you guys next time.